is substantial. DocuSign is down 42%. Cloudflare is down 30%. Zscaler is down 19%, as is Zoom. Salesforce and Palantir are 14%. CrowdStrike and Adobe are each down 11% just since the PAL pivot. So I'm wondering how we need to look at this space, Degas, today.
Yeah, so this really doesn't change the way we've been looking at the space because, you know, I looked at our portfolio and really saw what was performing and not performing in this last quarter. And we were really pleased that we stayed true to our discipline and did not get really carried away with the high valuation names that some of those names that you mentioned. What we're seeing is that there's still those quality tech names. So you want to look for fair valuation. You want to look for top decile profitability, growing expectation, and sound sustainability. If you look at those names, talk about software, you have Microsoft, you have Adobe. These type names are doing well. They pull back, but they're sound business models. And these business models are the ones that have growth in demand and supply. It has very little in the way of substitution and high barriers of entry. So those are the stocks you really want to focus on in the tech space. And that's what we've been continually to hold. And that's where the value is in this market.
I mean, Steve, the NASDAQ is selling off into the Fed decision. The NASDAQ's down 1% now. And if I told you, you know, I read you the names of the declines by percentage points since the PAL pivot. If you want to go off the 52-week highs, I mean, there's some unbelievable decliners here. Palantir is 60% off of its high. CrowdStrike is 33%. DocuSign's 54%. Cloudflare is 40%, you know, and on and on and on. These stocks haven't come in enough. How much more do they have to come down before you come on television and say, you know what, I think XYZ shares are buyable right now?
Well, clearly I don't think they've come down enough because I'm long SARK, which is the inverse to Cathie Wood's holdings, to give me representation on the short side there. Look, they overshot, in my view, way to the upside in terms of their valuation. So it's natural to overshoot to the downside. To me, they're still at, I think, ridiculously high valuation levels that were driven by free money. Now, money is still going to be all but free, even if the Fed tightens twice going forward this year. But it's bringing some, you know, some awareness to people that own these stocks and have had good gains, who are saying, I don't want to see them all dissipate, so I'm going to get out. And to the Johnny-come-latelys who have bought that have losses, they're going to book their loss before the end of the summer, before the end of the year. So, look, I still think that they're troubled stocks from a valuation standpoint. I'm not talking about their business models. Business models for a lot of them are good. But as I talk to bankers, and I can tell you that I've spoken to bankers at probably half a dozen firms over the last week and a half, and everybody's incredulous still at the valuations. So I think you've got a lot more downside to come into these. And what makes 40 times revenue the point where it stops versus 35 or 30? Just as what made 50 times revenue or 60 times revenue the top. So there's no rationalization to be able to come out with intrinsic values of what these companies should sell for. We know historically that larger number of stocks is valued way too highly. So I think there'll be more pressure on them.
I mean, Joe.
And one more thing, Scott. Can I just give you one thing? I'm sorry. In terms of technology, why that's suffering more is because while we look at vaccination rates in the U.S. as being fairly high, in the countries that make these goods, it's not so high. So they're more prone to the virus hitting them and shutting down their factories. That's the divergence, I think, between the S&P, Dow, and NASDAQ.